Hi, everyone, and welcome to this deep dive.
Great to be here.
Today, we're tackling a big question, one I know is on a lot of people's minds. What's the real story with India's economy and its stock market right now?
Yeah, it's a key topic.
We've been digging into some recent, quite detailed investment reports from Goldman Sachs to try and bring you a clear picture.
That's right.
And we want to focus specifically on what all this means for you, the retail investor.
Exactly. We know the market can feel, well, a bit bumpy sometimes, right?
Definitely.
And listeners are looking for solid information, something to help make sense of it all.
So our goal today is really to cut through the jargon, the noise.
Absolutely. Cut through the complicated finance speak and just give you a straightforward understanding of where things stand based on, this expert analysis from Goldman Sachs.
We're pulling out the key insights that matter most.
That's the plan.
Okay, so let's start with the big picture. When Goldman Sachs looks at India's economy and the stock market heading into 2025 and maybe beyond, what's their main takeaway? Is it sunshine or clouds?
Well, their overall view is one of, I'd say, cautious optimism.
Cautious optimism.
Yeah, they see the underlying fundamentals as strong. Very strong, actually. And they are expecting India's economy to pick up speed.
Pick up speed? How so?
They're projecting that the GDP growth rate, how fast the economy grows, will increase. They see it rising to around 6.4% in the second half of 2025.
6.4%. And what's behind that? What's supporting that kind of pickup?
Two main things they point to. First, the government's move to reduce income tax.
Yeah.
That should put more money in people's pockets, right?
Right, potentially boosting spending.
Exactly. And second, the possibility that the Reserve Bank of India, India's central bank, might cut interest rates further.
Ah, okay. Making borrowing cheaper.
Precisely. Both helpful for growth.
That sounds generally pretty positive then, for the medium term at least. What are some of the core strengths Goldman Sachs highlights? You mentioned strong fundamentals. What makes them confident in India's stability?
They point to several really important structural factors. India's trade situation, for instance, is improving.
Okay.
The central bank, the RBI, is seen as doing a good job managing inflation, keeping it in check.
Inflation targeting.
And there's a reliable amount of domestic investment happening. Domestic risk capital, they call it.
Okay, so money staying within India and being invested.
That's a big part of it. And what's really interesting, they mentioned India's relatively low beta compared to other emerging markets.
Low beta. What does that mean in simple terms?
It essentially means Indian stocks tend to be less volatile, less jumpy compared to stocks in other similar economies.
Yeah.
It's around 0.4, they estimate.
So a smoother ride, relatively speaking.
Kind of, yeah. And because of this relative stability, they believe Indian stocks can justify trading at somewhat higher valuations.
Interesting. Like a premium for stability. So that less bumpy ride might be worth a slightly higher ticket price, maybe?
That's a good way to put it, yeah.
Okay, interesting analogy. So if the long-term direction looks pretty decent, what's been behind this recent slowdown in the economy we've heard about? As a retail investor, should I be worried about that? Is it something serious?
That's a really important question. And Goldman Sachs sees this recent slowdown as cyclical, not structural.
Cyclical, meaning it's part of a normal up and down cycle, not a fundamental long-term problem.
Exactly. They attribute it largely to some, deliberate steps taken by the government and the central bank.
Deliberate steps, like what?
Well, the government, for instance, reduced its spending on things like infrastructure projects. Fiscal tightening, they call it. Trying to lower the fiscal deficit, the amount it borrows.
Okay, pulling back a bit on spending.
And the central bank, the RBI, they raised interest rates. That was monetary tightening. The goal there was to control inflation and ensure financial stability.
Right, making borrowing more expensive to cool things down.
And they also tightened some rules around lending, especially for unsecured loans, loans not backed by collateral. That was about reducing risk in the system.
Okay. So these actions, while they might have slowed growth a bit in the short term, they were actually aimed at creating a more stable foundation for the future. Is that the idea?
That's exactly how Goldman Sachs seems to frame it. Important for long-term stability, even if it meant a temporary growth impact.
Okay, that makes sense. So these were intentional moves for long-term health. What's being done now to sort of get the economy growing faster again?
Right. So now we're seeing measures designed to actually boost growth. The government's decision, for example, to have zero tax on incomes up to 12 lakh rupees. That's pretty significant.
Yeah, it leaves more money with a large group of people.
Definitely. And the RBI, the central bank, started easing its policy too. They cut interest rates by a quarter of a percentage point back in February 2025.
Okay, the first cut in a while, wasn't it?
First since August 2023, yeah. And there's an expectation that we might see more small cuts like that through 2025.
More easing potentially on the way.
Potentially. Plus, the RBI has also been injecting liquidity, putting more cash into the system by buying government bonds. That helps banks have more money available to lend out.
Okay, so steps are being taken to stimulate things again. Good to know. Now let's switch gears a bit and talk about the stock market itself. How have Indian stocks actually been performing, and what's Goldman's view on, well, how expensive or cheap they are right now?
Right. So looking back over the last 5 years, Indian stocks have actually outperformed the broader emerging market average, done quite well.
Better than average, okay.
But more recently, say since September 2024, we've seen a bit of a pullback, a dip,
Yeah, I think people have felt that.
for sure. And that's mainly due to that slower economic growth we just discussed.
Yeah.
And also some broader worries in global markets, a bit of risk-off sentiment.
Risk off meaning investors getting nervous and selling riskier assets.
Exactly. So, for example, the Nifty Y50 index, the top 50 companies, it fell about 10% from its peak.
Okay. And what about valuations? How expensive are stocks now?
That's the key point.
Yep.
The main India stock market index, the MSCI India, it's currently trading above its average price over the last 10 years.
Above average.
And it's also above what Goldman Sachs considers to be sort of its fair value estimate.
So that suggests, what, potential downside risk?
It suggests there's a possibility that prices might need to adjust downwards a bit, yeah.
Yeah.
Potential risk of derating, as they call it.
Okay. And what about company earnings? Because that's usually a key driver for the market, right?
Absolutely. Crucial. The general expectation, the consensus forecast, is still for pretty healthy earnings growth, around 14-15% for both 2025 and 2026.
That sounds pretty solid, 14-15%.
It is. However, it's worth noting that the forecasts for FY26, so for the financial year 2026 earnings per share, they have been revised downwards slightly recently.
Okay. So still growing, but maybe not quite as fast as previously thought for 26.
Something like that, yeah. A slight moderation in expectations.
So putting all that together, the growth outlook, the valuations, the earnings picture, what does Goldman Sachs actually expect for the stock market in the near future? What are their predictions for, say, the Nifty Y50? As a retail investor, what should I brace for?
Well, in the short term, the next few months, they anticipate the market will likely be range-bound.
Range-bound, meaning not going up dramatically, but maybe not crashing either, just sort of sideways.
Pretty much, yeah. Moving within a certain range. And that's because of that mix of factors. The slowing economic growth we've seen, the fact that valuations are already a bit high,
Yeah.
and those slight downward revisions in earnings forecasts.
Okay, so maybe a bit choppy in the near term.
Likely. Their specific forecast for the Nifty Y50 is around 24,000 in the next 3 months.
24,000. And longer term, say by the end of 2025?
By the end of 2025, they see it rising to 27,000.
Okay, so a decent rise expected towards the latter part of next year.
Yes, and that expected increase is really based on the idea that company earnings growth at 14-15% we mentioned will come through as anticipated.
Driven by earnings. Okay. So given this overall outlook, cautious near term, better later, focus on earnings, what's their general advice on investing in India compared to other emerging markets? Should I be looking to invest more, less, or kind of stay put in India right now?
They currently have what they call a market weight stance on India within the broader emerging markets context.
Market weight. So basically neutral, neither overweight nor underweight.
Exactly. It means they suggest holding an allocation to India that's roughly in line with its proportion in the broader emerging market indices. Their main advice, though, is to be very selective.
Selective, meaning focus on picking the right individual stocks.
Precisely. Focus on bottom-up stock selection. They recommend concentrating on companies expected to have strong earnings visibility and good quality growth.
Quality growth, okay.
And this includes looking beyond just the big names. Consider mid-size and smaller companies, even off benchmark names, if they fit that profile.
So it's less about just buying the whole market and more about picking specific winners.
That's the core message for now, yes.
Okay, this gives us a really good overview of the macro picture and the market outlook. Now let's really zero in on you, the retail investor listening to this. What specific opportunities is Goldman Sachs pointing out that might be particularly relevant for individual investors like us?
Right. This is crucial. One really important trend they highlight, which directly involves retail investors, is the massive increase in domestic inflows through SIPs.
Ah, yes, systematic investment plans. Lots of people use those.
Exactly. These regular fixed amount investments, often monthly. The flows into these have now gone beyond 3 billion US dollars every single month.
Wow, $3 billion a month? That's huge.
It's substantial. And they see this as playing a vital role in stabilizing the market, especially during periods of volatility when foreign investors might be selling.
So domestic retail investors are actually providing a cushion.
A significant one, yes. And this trend is driven by a couple of things. Growing financialization, meaning more
Oh,
people participating in formal financial markets.
more awareness, more access.
Right. And also rising per capita incomes. More people simply have more capacity to save and invest. This consistent buying pressure is a real support.
That's actually really encouraging to hear about the strength of domestic retail participation. It makes you feel like you're part of something significant.
Absolutely. It's a structural shift.
Now, moving beyond that overall trend, are there specific sectors of the economy that Goldman Sachs believes have particularly strong growth potential? Sectors that might be worth a closer look for individual investors?
Yes, definitely. They've identified several sectors where they see promising growth ahead. Let's start with the financial sector.
Banks, NBFCs, that sort of thing.
Exactly. Banks and other lending companies. They're seeing positive signs here, partly because those government and RBI measures we talked about earlier, the tax cuts, lower reserve requirements for banks, the CRR cut, injecting liquidity,
Right. Things designed to help lending and the economy.
and also the rollback of those higher risk weights on certain types of NBFC lending. Plus, they feel the valuations, the prices of many financial stocks look quite reasonable right now.
Okay, so financials look interesting. Are there any particular companies within that sector that they seem optimistic about? Any specific names mentioned?
They did mention a couple of key players. First is HDFC Bank.
A big one, obviously. Why do they like it?
Several reasons. It's been gaining market share in customer deposits, which is crucial for banks. They see it managing profitability well, even while it works on its loan-to-deposit ratio. Loan growth looks good across different segments, retail, commercial, rural banking.
Diversified growth.
Yes. And its credit card business is accelerating, gaining market share there too. Plus, asset quality, the quality of their loans, remains stable.
Okay, solid fundamentals. Any sense of potential upside?
Their target price suggests a potential upside of around 12% from its current level at the time of the report.
12%. Okay. And who was the second one?
The second one was AU Small Finance Bank.
Ah, a smaller finance bank. What's the thinking there?
They believe this bank is set for strong growth momentum, especially in the second half of the next financial year, FY26. They expect some recent loan losses to peak and then decrease.
So, expecting an improvement in performance.
Yes, they're forecasting significant growth in both loans and deposits. Good earnings growth is expected, and they see the asset quality in their core loan book as healthy.
And the potential upside sounds like maybe more than HDFC.
Potentially, yes. Their target price indicated a quite significant potential upside of around 40%.
40%. Okay, that's definitely noteworthy. Of course, higher potential often comes with different risks, too.
Naturally,
Yeah.
smaller banks can have different risk profiles.
Right. Okay, moving on from financials. What about sectors related to, what people buy? Consumer goods, services?
The consumer sector is another area they're optimistic about.
Why is that?
They expect things to improve here for a couple of reasons. Food inflation, the rate at which food prices increase, is expected to moderate, which helps household budgets.
Less pressure from food prices, okay?
And those income tax cuts we discussed should leave people with more disposable income, boosting demand for various goods and services.
Makes sense. More money to spend. Any specific companies in the consumer space that looked promising in their analysis?
Yes, they highlighted two main ones here. First is Titan.
Jewelry, watches, eyewear.
Exactly. They focus quite a bit on the more affluent segment of Indian consumers, which has been resilient. Titan has been consistently gaining market share at its key categories.
Strong brand, market share gains.
Yes. And they're also expecting their profit margins to improve. Their target price suggested a potential upside of around 20%.
20% for Titan.
Yeah, okay.
And the second consumer name?
The second was Godrej Consumer Products, household goods mostly.
Right. Soaps, repellents, air fresheners.
That's the one. They see potential for Godrej to gain market share, partly driven by new product formulations like in mosquito repellents. They also expect sustained growth in their air care and fabric care segments.
New products driving growth.
potentially. And they anticipate a recovery in their overall profit margins, their EBITDA margin. Their target price indicated a potential upside of about 13%.
Okay, 13% for Goddard consumer. Now, infrastructure development has been such a big theme in India for a while. What's Goldman Sachs' take on companies in that sector now? Still positive?
Yes, they remain positive on the infrastructure sector overall. The main reason is the government's continued strong focus on investing in infrastructure. That remains a priority.
Makes sense. It's crucial for long-term growth. Which specific infrastructure-related stocks caught their eye?
They highlighted Adani Ports.
Interesting. How do they view Adani Ports right now?
Well, they note the stock hasn't been a top performer recently, but they believe it's trading near its long-term median valuation, suggesting it's reasonably priced compared to its history.
So, potentially not overly expensive?
Right. And they expect a better growth outlook for the next financial year, FY26. They do mention risks, of course, like its international exposure and ongoing capital expenditure, the money it spends on new assets.
Always important to consider the risks.
Absolutely. But they seem to feel the potential rewards could outweigh those risks, with a target price suggesting around a 15% upside.
15% potential for Adani Ports. Okay. Who else in infra?
The second was Interglobe Aviation, which operates Indigo Airlines.
Ah, the airline giant. What's the rationale there?
Well, they have clear market leadership in India, and Goldman Sachs expects them to sustain that market share. Their low-cost business model is a strength,
Cost leadership, yeah.
and they also see potential for growth in their international business.
Okay, international expansion. Any caveats?
Well, they do note the usual risks for airlines' volatile oil prices, the Indian rupee potentially depreciating, potential delays in getting new aircraft capacity. And interestingly, the current stock price at the time of the report was already quite close to their target price.
Oh, so not a huge implied upside currently.
Not based on that specific target. They mentioned the target is based on the relationship between RASK, revenue per available seat kilometer, and CASK, cost per available seat kilometer. Basically, the gap between revenue earned per seat flown and the cost of flying that seat.
Okay, so maybe more of a hold or watch, depending on price movements.
Could be interpreted that way, yes.
Yeah.
Need to look at the current price relative to the target.
Got it. What about the automotive sector? Cars, bikes, tractors. Any interesting trends or companies there, according to Goldman?
In the auto sector, they're focusing on a couple of key themes. One is premiumization, the trend of people buying higher-end, more feature-rich vehicles.
People upgrading their cars.
Exactly. And the other is a potential rebound in rural consumption, which impacts things like tractor sales.
Okay. And which company stood out?
They particularly liked Mahindra and Mahindra, M&M.
M&M. Why them specifically?
Because they have a strong position in the growing SUV segment, which fits that premiumization trend. They also seem to have better visibility on future sales volumes, thanks to their upcoming new product pipeline and existing order backlogs.
So, good visibility on future growth?
Seems so. And their tractor division, which is linked to that rural theme, is also performing strongly.
Okay, multiple drivers. What kind of potential upside are we talking about for M&M?
Their target price suggested quite a substantial potential upside, actually. Over 40%.
Wow, over 40%. That's significant.
It is, yes. Reflecting that positive view on their positioning.
Okay, let's turn to healthcare, another really important area. What's their perspective on, say, the hospital sector?
For the hospital sector, they see several growth drivers. India is still seen as an underpenetrated market for quality healthcare.
Meaning there's room to grow, not enough facilities or access yet.
Exactly. Plus, you have an aging population, rising incomes allowing more people to afford private health care, and higher health insurance penetration helping people pay for it.
All feeding into demand for hospital services.
Right. Within that space, they favor Apollo hospitals.
Apollo. What are the reasons there?
They expect continued ramp-up in occupancy rates at their hospitals. They also anticipate their digital health platform, Apollo 227, will reach break-even soon, meaning it stops losing money.
The digital side becoming profitable.
That's the expectation. And they're also expanding their network of diagnostic centers. They're forecasting strong growth in EBITDA, a measure of profit, and their target price indicated around an 18% potential upside.
18% for Apollo. Okay. And finally, one more sector. What about power, especially with the big push towards renewable energy?
Yes. In the power sector, they see Power Grid as a key beneficiary.
Power grid. They handle the transmission infrastructure, right?
Primarily, yes. The big power lines. They benefit from the growth in renewable energy projects because all that new green power needs to be connected to and transported across the grid. and the grid itself needs expansion.
So more investment needed in transmission.
Definitely. They highlight power grid's strong balance sheet, its low cost of debt, which helps finance projects cheaply, and its proven execution capability. They're good at getting these large projects done.
Solid company profile. Potential upside.
Their target price suggested a potential upside of around 22%.
Okay, 22% for power grid. That's a lot of specific company insights.
It is. Provide some concrete ideas.
But it's really crucial, and we need to emphasize this, that these are analyst recommendations and viewpoints from Goldman Sachs based on their research at a specific point in time.
Absolutely critical point.
You, as the individual investor listening, you must do your own thorough research. Consider your own financial situation, your risk tolerance, your investment goals before making any decisions. This isn't direct investment advice.
Couldn't agree more. Use this as a starting point for your own due diligence, not the final word.
Okay. Now, stepping back again to look at the bigger picture, we talked about the potential for near-term volatility. What are some of the broader factors driving that current market choppiness? What should retail investors keep in mind about why the market might be bumpy right now?
Yeah, understanding the why behind volatility is helpful. There's several factors at play. On the global front, there's some uncertainty around U.S. economic policy, particularly the potential for trade tariffs, which can impact global trade flows.
Geopolitics always a factor too.
Always. Geopolitical tensions are bubbling up in various parts of the world, which makes investors nervous. We're also seeing rises in crude oil prices, which can impact inflation and company costs.
And foreign investors.
We've seen some FII outflows, foreign institutional investors selling some of their Indian holdings, which can put pressure on the market.
Okay, so global factors are definitely playing a role. What about domestic pressures within India?
Within India, we mentioned those slight earnings downgrades for some companies. There's been evidence of a consumption slowdown, people perhaps spending a bit less cautiously. And there have been some regulatory changes, like SEBI's norms for alternative investment funds, AIFs, and portfolio management services, PMS, which can impact market dynamics.
Right, regulatory adjustments.
And then there are market-specific dynamics. We touched on valuation concerns. The feeling that some stocks, maybe especially small and mid-caps, had become stretched or expensive.
The high PE ratios people talk about.
Exactly. We're also seeing sectoral shifts where money moves out of certain types of stocks, like maybe growth or momentum stocks that were doing well, and into others.
Rotations within the market.
Correct.
Right.
And we also have upcoming event risks, things like the full union budget announcement, RBI policy meetings. These can create uncertainty leading up to them.
Things the market waits for.
And we've seen tangible signs of this volatility. The India VIX index, which measures expected volatility, has spiked at times.
Yeah.
And the overall market capitalization, the total value of the stock market, has eroded somewhat from its peaks.
Okay, so a combination of global, domestic, and market factors making things jumpy.
That's a good summary, yes.
So in this kind of environment where we might continue to see these swings, what are the most important takeaways from these Goldman Sachs reports? What should retail investors really keep front of mind?
Okay, let's boil it down. Key points. First, despite the near-term bumps, the long-term outlook for India's economy and stock market is still seen as fundamentally strong. Cautious optimism, remember.
Right. The long-term view remains positive.
Second, expect the economy, the GDP growth, to improve, particularly in the second half of 2025.
Growth picking up later next year.
Third, market volatility is likely to stick around in the near term. Don't be surprised by ups and downs.
Race for choppiness.
Fourth, the best approach right now, according to this analysis, is to be selective. Focus on bottom-up stock picking. Look for individual companies with strong earnings potential in those promising sectors we discussed.
Financials, consumer, infra, auto, healthcare, power.
Exactly. Focus on quality growth within those areas. And finally, remember the stabilizing role of domestic retail participation. Those SIP flows are a significant positive force.
The power of the retail investor.
Indeed. It's a structural support for the market.
Okay. So, based on all of this insight from Goldman Sachs, what would be your key pieces of advice for retail investors listening right now? What should they practically be focusing on, and how should they approach the market in this phase?
All right. Based on these insights, here's what I'd suggest keeping in mind. First, focus on fundamentals. Prioritize investing in businesses that are actually making good profits, have strong earnings visibility, and solid management. Just like Goldman Sachs recommends, quality matters.
Don't just chase hype, look at the underlying business.
Precisely. Second, consider sectoral themes. Look closely at those sectors we discussed that seem to have good long-term growth prospects: financials, consumer, infrastructure, and so on. Aligning investments with these broader economic trends can be sensible.
Invest where the growth is expected.
Third, be mindful of volatility. Accept that the market might continue to swing up and down in the short term. Try to avoid making impulsive emotional decisions based purely on these short-term movements.
Easier said than done sometimes, but important. Don't panic sell or FOMO buy.
Very true. Fourth, while it wasn't a major focus in these specific reports, always remember the importance of diversification. Spreading your investments across different types of companies and sectors helps manage risk. Don't put all your eggs in one basket.
Classic advice, but always relevant.
Fifth, take a long-term perspective. The positive long-term outlook for the Indian economy suggests that patient investors who stick with quality investments may well be rewarded over time.
Think years, not weeks or months.
Exactly. And finally, number 6, continuous learning and research. Stay informed, read, learn, and always do your own homework, your own due diligence before investing your hard-earned money in any company.
Echoing that earlier point, do your own research.
It's the most crucial piece of advice, always.
This has been a really valuable deep dive. We've covered the economic outlook, the market views, specific sectors and stocks, the volatility factors, and some actionable pointers, all drawing from that Goldman Sachs analysis and hopefully framed it clearly for you, the retail investor.
Absolutely. The aim was clarity and actionable insights based on expert analysis.
And it leaves us perhaps with a final thought for you, our listener, to mull over.
Yeah, something to think about. Considering these sectors that are expected to grow: financials, consumer, infra, and the rest, and given the current market dynamics we've discussed, what specific long-term trends do you personally believe will have the biggest impact on your investment journey in the Indian market?
Interesting question. Thinking beyond just the immediate forecasts.
Exactly. What broader shifts, technological changes, social trends do you see shaping the Indian market landscape in the years to come? Something to ponder.
A great question to leave our listeners with. Thanks for tuning into this deep dive, everyone.
Thanks for listening.
We'll be back with more insights next time.